Okay, let's jump right into this. If you've been watching the markets lately and feeling, well, a little cautious, you are absolutely not alone. There is a whole lot of uncertainty in the air right now. And jumping in blindly, yeah, that's just a recipe for disaster. And that's exactly why today's explainer is built entirely as a risk-first playbook. We're going to put on our analyst hats today and walk through a really solid, data-backed breakdown of the top stock recommendations for May 20th. This is all sourced directly from a highly detailed money control report. We're going to look at the precise ticker symbols, the exact strategies, and the underlying technical indicators driving them. But most importantly, we're doing this while focusing on keeping your capital protected.
Now, what's really fascinating here is this exact quote from the Money Control Report. It completely validates any of that hesitation you might be feeling about jumping in with both feet right now. They point out that the benchmark indices actually wiped out their gains in late trade recently, finishing moderately lower, even though market breadth was looking a bit better. So what does that tell us? It tells us we are stuck in a holding pattern until we get a truly decisive breakout. We need a highly calculated approach right now, not a speculative one.
So here's our roadmap for today. 1. Market context and strategy. 2. Spotting the reversals. 3. Riding the breakouts. 4. The downside warning. And finally, 5. Final risk assessment.
All right, kicking things off with Section 1, Market Context and Strategy.
So, the analysts in the report repeatedly use this word consolidate. But what does that actually mean for us on a day-to-day basis? Well, consolidation is essentially a phase where the market is just catching its breath. It's trading inside this tight, limited price range, basically trapped between a floor and a ceiling. It screams indecision. The buyers and the sellers are just at a complete stalemate. And this is exactly why patience, precision, and, above all else, strict stop losses are so absolutely crucial right now. You definitely don't want to get chopped up in all that indecision.
Moving right along to Section 2, Spotting the Reversals.
To actually spot these reversals, the experts at Kotak Securities, who are referenced in the report, they rely heavily on the Simple Moving Average, or the SMA. You can think of the SMA as this nice, smoothed outline that just cuts right through the chaotic daily noise of the market to reveal the actual underlying trend. Specifically, we're focusing on the 20-day SMA. In this playbook, it acts like our safety net. When a stock's price manages to cross back above that 20-day average, it gives us real mathematical confirmation that the nasty downtrend has probably stopped, and a fresh uptrend is kicking off. Take a look at our reversal dashboard here. According to Amal Athawale over at Kotak Securities, we've got 3 stocks, Bandhan Bank, SBI Life, and Bajaj Finserv, that have formed these really promising reversal patterns right above crucial support levels. But notice the strict discipline here, guys. Every single buy strategy comes attached to a clearly defined target and a completely non-negotiable stop loss. For example, Bandhan Bank just completed a one-leg correction, and it's trading right near its 20-day SMA. Meanwhile, Bajaj Finserv found solid support near a major retracement level.
So, the absolutely critical part here is understanding your risk. Let's just anchor on SBI Life Insurance for a second. The recommended stop loss is set exactly at 1,850 rupees. Why that specific number? Well, because while the stock is currently holding a higher bottom and it's trading above that 20-day SMA we just talked about, if it drops below 1,850, that entire upturn becomes incredibly vulnerable. If the price hits that number, the whole thesis is broken, we exit the trade and we protect our capital. No emotions involved, just pure execution.
Now, let's look at our next reversal play. This one involves a very specific visual pattern called the cup and handle. I know, it sounds a bit like we're setting up for a fancy tea party, but it's actually a classic, highly reliable bullish signal. The price action literally draws a teacup on the chart. The cup part is this U-shaped recovery that shows consolidation, and the handle is just a slight downward drift right before the stock potentially bursts upward.
And that brings us to Hexaware Technologies, highlighted in the report by Ashish Kyal of Wave Strategy Advisors. The setup here is just fantastic for a really calculated buyer. It's hovering around 510 rupees right now. The upside targets are 540 and 565, with a firm, protective stop loss down at 495. So what's giving us confidence here? Well, since mid-March, it has consistently been forming higher highs and higher lows. But even more importantly, the volume, the actual number of shares changing hands, has seen a massive spike, hitting its highest level since early April. That rising volume, paired with a breakout from that cup and handle pattern on a lower time frame, adds a ton of bullish probability to this trade.
All right, shifting gears a bit to Section 3, Riding the Breakouts. Before we dive into the specific tickers, we got to add one more tool to our analyst toolkit, Fibonacci retracement. Now don't worry, we aren't going to get bogged down in the complex math today.
Basically, these are just horizontal lines drawn on a chart that show us where a falling stock is highly likely to find support, a floor, during a pullback. It essentially gives us mathematical confidence that a stock is bouncing off a solid foundation, rather than just floating in thin air.
So here is our momentum breakout dashboard for May 20th. We've got 4 really strong buys lined up here: Angel One, Latent View Analytics, Arvind, and Glenmark Pharma. But again, I really want you to look at the right side of those numbers. Even with this kind of momentum, and admittedly a slight increase in risk, I want to assure you that every single one of these trades has a clearly defined exit plan. We know exactly where we are pulling the ripcord if the market suddenly turns against us.
To reassure you even further, let's unpack the specific technical why behind these breakouts. We are definitely not just chasing shiny green candles blindly here. Angel One just broke out of a long-term triangle pattern, and it's actually finding support from the baseline of the Ichimoku Cloud Indicator. Latent View? It surged after perfectly testing that 61.8% Fibonacci retracement level we were just talking about. Arvind has successfully broken out of a long-term cup pattern, with its major exponential moving averages, or EMAs, firmly sloping upwards. And finally, Glenmark broke a falling trend line on rising volumes and clawed its way back above its 20-day EMA. The data absolutely backs up the momentum.
But hey, we all know momentum can be a double-edged sword, right? Let's punch in the Angel One stop loss at 308 rupees. The report specifically calls out that Angel One's really sharp upward move has unfortunately pushed its short-term oscillators into the overbought zone. Basically, the stock might be running just a little too hot right now. Because of that, the strategy isn't to just buy blindly at the very top. Instead, you want to buy on the dips toward the 323 to 326 range. And honoring that hard floor at 308, that is absolutely mandatory.
Which leads us nicely into Section 4, the downside warning.
A truly objective analyst doesn't just scan the horizon looking for reasons to buy. They are always actively hunting for hidden dangers too. I want to use this comparison to visually show you what a toxic, downtrending chart looks like right next to a healthy one. Look over at Arvind on the left. This is our buy. It's making higher highs and higher lows, steadily trading above its ascending moving averages. It's essentially marching up the stairs. Now look at Loaded Developers on the right. It is making lower highs and lower lows, and it's trapped below its descending moving averages. It's literally falling down the stairs.
And because of that downward slide, Aditya Thukral has placed a strict sell recommendation on Loaded Developers. The actual strategy here is to sell in the futures segment below 885 rupees, with a target of 835 and a protective stop loss set above 910. The massive, glaring warning sign here is something called RSI divergence. This is a nasty negative reversal pattern where the actual price of the stock is forming lower highs, but the 14-period RSI indicator is somehow forming higher highs. That divergence is a massive technical red alert. It often predicts a brutal breakdown to fresh 52-week lows in the coming weeks. You definitely want to avoid getting caught in that kind of downward momentum.
Finally, wrapping things up with Section 5, Final Risk Assessment.
Okay, we need to bring all these technical indicators, the Fibonacci levels, the SMAs, the cup and handles, all the way back to your core portfolio philosophy. Today we unpacked a grand total of 9 specific stock recommendations from May 20th, straight from the Money Control report. Out of those 9, we have 8 highly calculated buys, which are spread across reversal plays and momentum breakouts, and exactly 1 strict sell warning on Loaded Developers. But the single unifying theme across all 9 of these setups is that every single one demands strict, uncompromising risk management. Whether your target is 205 on Bandhan Bank or 2550 on Glenmark, the stop loss is your ultimate safety net in a choppy, consolidating market.
So I really want to leave you with this provocative thought today. Think about the data we just covered. We know for a fact the market is in a holding pattern, just waiting for a decisive move. We know the exact technical levels where these 9 stocks become highly favorable and exactly where those setups completely fail. So the question isn't just whether these are good stocks. The real question is, does your personal risk appetite right now actually align with executing these technical setups and strictly honoring these stop losses? Take a really hard look at your portfolio and decide for yourself before the opening bell rings. Thanks so much for joining me on this explainer. Keep your stops tight and stay focused out there.